Investor sentiment showed signs of caution as the CNN Money Fear and Greed Index shifted to a neutral zone, reflecting a more balanced market outlook. The Dow Jones Industrial Average dipped by over 150 points, closing at 44,785.50, as market participants adopted a risk-off stance in anticipation of Federal Reserve Chair Jerome Powell's speech at the Jackson Hole Symposium. The speech is closely watched for insights into future monetary policy directions, which could significantly influence market dynamics. The S&P 500 and Nasdaq Composite also registered declines, with the former falling by 0.40% and the latter by 0.34%. Corporate earnings reports further influenced market movements, with Walmart Inc. experiencing a 4.5% decline in share price despite raising its annual outlook following mixed second-quarter results. Coty Inc. saw a more dramatic drop of around 22% after missing fourth-quarter adjusted EPS expectations. Economic indicators also painted a mixed picture. U.S. initial jobless claims rose to 235,000, surpassing expectations, while existing home sales increased by 2% in July. The S&P Global Services PMI saw a slight decline, whereas manufacturing PMI showed improvement, indicating a potential shift in economic activity. Amidst these developments, the energy and materials sectors outperformed, providing some counterbalance to broader market losses. Investors remain vigilant, awaiting further corporate earnings and economic data releases.
Aptorum Group Limited, APM, experienced a significant decline of 33.18% in after-hours trading on Friday, closing at $2.84. This drop followed a remarkable 234.65% surge on Thursday, highlighting the stock's volatile nature. The trading volume on Friday was notably high, with 168.16 million shares exchanged, compared to the average of 6.87 million, indicating heightened investor interest and activity. The stock has fluctuated within a 52-week range of 48 cents to $7.49, and the company currently has a market capitalization of $30.36 million. The volatility in Aptorum stock is partly attributed to developments involving its merger partner, Diamir Biosciences Corp. Diamir recently received approval from the New York State Department of Health for its APOE genotyping test, which assesses cognitive decline risk. This approval allows the CLIA-certified lab to offer enhanced risk assessment and personalized care strategies, potentially increasing its market reach. The two companies announced an all-stock merger in July, with Diamir set to become a wholly owned subsidiary of Aptorum, maintaining its Nasdaq listing. This merger, expected to close in the fourth quarter, is anticipated to strengthen Aptorum's position in the biotech sector, potentially impacting its future stock performance and investor sentiment.
Tempus AI, Nasdaq TEM, experienced a notable 4.7% increase in its stock price, following an analyst upgrade by BTIG Research, which raised its price target from $75 to $85, maintaining a buy rating. This surge in stock price comes amid a backdrop of mixed analyst ratings, with 6 analysts recommending a buy and 6 a hold, resulting in a consensus moderate buy rating and an average price target of $67.64. The trading volume was significantly lower than average, with 5,906,707 shares traded compared to the usual 12,529,988 shares, suggesting a potential consolidation phase post-upgrade. The company's financial health shows a complex picture, with a market cap of $13.33 billion and a high beta of 4.98, indicating significant volatility. Despite a negative earnings per share (EPS) of 22 cents for the recent quarter, Tempus AI exceeded analyst expectations by 1 cent. The company reported a substantial revenue increase of 89.5% year-over-year to $314.64 million, reflecting robust growth in its AI-enabled precision medicine solutions. However, with a negative return on equity of 122.86% and a high debt-to-equity ratio of 2.58, the company faces challenges in profitability and financial leverage. Institutional investors like Vanguard and ARK Investment Management have significantly increased their holdings, signaling confidence in the company's long-term potential despite short-term financial hurdles.
Jefferies Financial Group recently adjusted its price target for Okta, Nasdaq Okta. lowering it from $105 to $100 while maintaining a hold rating. This adjustment comes amidst a mixed consensus from various research firms on Okta's market performance. Notably, D.A. Davidson reduced their target from $145 to $140 but still recommended a buy, while J.P. Morgan Chase & Company increased their target to $140 with an overweight rating, indicating confidence in Okta's growth potential. The average price target for Okta currently stands at $117.92, reflecting a broad range of analyst expectations. Okta's recent financial performance shows a robust Q1 with earnings per share, EPS, of 86 cents, surpassing the consensus estimate of 77 cents. The company's revenue increased by 11.5% year-over-year to $688 million. Despite these positive results, Okta's stock opened at $89.78, reflecting some market caution. The company's strategic focus on identity management and security solutions continues to attract institutional interest, with hedge funds holding approximately 86.64% of its stock. Insider trading activity has seen significant stock sales by executives, which could influence investor sentiment. As Okta sets its guidance for Q2 2026 at 0.830 to 0.840 EPS, market participants will be closely monitoring its ability to sustain growth amidst varying analyst perspectives.
Lisata Therapeutics, Nasdaq LSTA, received a reaffirmation of its buy rating from H.C. Wainwright, with a set price target of $15 per share. This follows an earlier increase in the target price by Brookline Capital Management, which raised its target from $20 to $32, also maintaining a buy recommendation. The consensus among analysts, as reported by MarketBeat, places the stock at a buy rating with an average target price of $23.50. This bullish sentiment comes despite the stock's current trading price of $2.47, indicating significant potential upside according to these projections. Lisata Therapeutics, a clinical-stage pharmaceutical company, focuses on innovative therapies for treating solid tumors and other diseases. The company recently reported quarterly earnings that exceeded expectations, with a loss per share of 54 cents against the anticipated 65 cents, and minimal revenue of $0.07 million. Despite its small market capitalization of $21.64 million and a negative P/E ratio, the stock has drawn interest from institutional investors, who now hold 8.94% of the company. This interest suggests confidence in the company's pipeline, which includes promising candidates in various stages of clinical trials, such as LSTA1 for metastatic pancreatic ductal adenocarcinoma and XOWNA for coronary microvascular dysfunction. The combination of positive analyst ratings and strategic investor interest might signal potential growth opportunities for Lisata Therapeutics in the biotech sector.
Barclays has revised its price target for Insulet Corporation, Nasdaq, POD, a leading medical instrument supplier specializing in insulin delivery systems, from $266 to $300, maintaining an equal weight rating. This adjustment comes amidst a flurry of positive analyst ratings, with Citigroup and Wall Street Zen both upgrading their recommendations to buy, and Raymond James Financial boosting its price objective to $360. The consensus among 16 analysts is a moderate buy, with an average price target of $332.71, reflecting strong market confidence in Insulet's growth trajectory. Insulet's recent financial performance underscores this optimism, with the company reporting a 32.9% year-over-year increase in quarterly revenue to $649.10 million, surpassing analysts' expectations. The company's EPS of $1.17 also exceeded forecasts by 25 cents, showcasing robust operational efficiency and market demand. Insulet's innovative Omnipod platform, which includes systems like the Omnipod 5 and Omnipod Dash, continues to drive growth and market penetration, particularly in the insulin-dependent diabetes sector. This positive financial outlook has attracted significant institutional interest, with major players like Vanguard Group and Geode Capital Management increasing their holdings, further solidifying Insulet's position as a promising investment in the medical technology space.
Anondita Medicare, a condom manufacturer based in Uttar Pradesh, has launched its initial public offering, IPO, on August 22, with the subscription period closing on August 26. The company plans to list its shares on NSE Emerge by September 1st. The IPO is attracting significant attention in the gray market, where shares are already trading at a premium of 58 rupees, suggesting potential listing gains of up to 40%. The IPO consists of a fresh issue of 47.93 lakh shares, with a price band set between 137 rupees to 145 rupees per share, aiming to raise 69.5 crore rupees in total. The funds raised from the IPO will be utilized to purchase new equipment and machinery, with 6 crore rupees allocated for this purpose, while 35 crore rupees will address working capital requirements. The remaining funds are earmarked for future acquisitions and general corporate purposes. Anondita Medicare, known for its Cobra brand condoms, operates 11 production lines with an annual capacity of 56.2 crore condoms. The company competes with listed firm Cupid in the same segment. The IPO presents opportunities for both short-term gains and long-term investment, contingent on market reaction post-listing.
Mangal Electric Industries Limited's initial public offering, IPO, has garnered significant interest, with the issue being subscribed 2.67 times on its final day. Primarily driven by non-institutional buyers, the IPO, a book-building issue valued at 400 crore rupees, consists entirely of a fresh issue of 71 lakh equity shares. Notably, there is no offer for sale component, indicating that the company is raising capital directly from the market to fund its operations or expansion plans. The bidding saw non-institutional investors leading with a 6-fold subscription, whereas retail investors showed a 2.70 times subscription and qualified institutional buyers lagged with only 0.14 times subscription. The IPO's gray market premium, GMP, stood at 32 rupees, suggesting a 5.07% potential listing gain, with an implied listing price of 593 rupees. This indicates positive market sentiment and potential upside for early investors. The shares are slated to list on the BSE and NSE on August 28, 2025, and the successful subscription suggests robust investor confidence in Mangal Electric's business model and growth prospects. The lead manager for the IPO is Systematics Corporate Services Limited, with Big Share Services Private Limited acting as the registrar. This successful IPO could provide Mangal Electric with the necessary capital to expand its operations in the transformer components manufacturing sector, potentially enhancing its market position and financial performance.
Sumitomo Electric Industries Limited, OTCMKTS SMTOY, has experienced a notable reduction in short interest, with shares shorted decreasing by 27.6% from July 15 to July 31. This decline in short interest, now totaling 34,900 shares, suggests a shift in investor sentiment, potentially reflecting increased confidence in the company's performance or future prospects. The days to cover ratio, a metric indicating how many days it would take to cover all short positions based on average daily trading volume, stands at a low 0.2 days, highlighting the relatively low level of short interest in relation to the stock's liquidity. In recent analyst activity, the Goldman Sachs Group upgraded Sumitomo Electric Industries from a hold to a strong buy rating, while Jefferies Financial Group has moved their rating to hold. These changes contribute to a consensus buy rating for the company, according to MarketBeat.com. The stock opened at $26.3725, showing a year-to-date upward trend with a 50-day moving average of $23.26 and a 200-day moving average of $19.49. Sumitomo Electric Industries, a diversified global manufacturer of electric wires and cables, operates across various segments including automotive and info communications, which could be driving the positive outlook and investor interest. The company's strategic positioning in sectors like electronics and energy might be bolstering its market performance amidst evolving industry dynamics.
Hulic Company, Limited, OTCMKTS HULCF, a Japanese real estate company, has experienced a notable increase in short interest, with figures rising by 32.4% from mid-July to the end of the month. The total short interest reached 2,690,700 shares by July 31st, a significant jump from 2,032,700 shares on July 15th. This surge in short interest, coupled with an average daily trading volume of just 200 shares, results in an exceptionally high short interest ratio of 13,453.5 days. This metric suggests that it would take a substantial amount of time for short sellers to cover their positions, indicating a potential bearish sentiment among investors regarding Hulic's stock performance. Despite the increase in short interest, Hulic's stock price has shown resilience, trading up by 10.0% to open at $10.80 on the latest trading day. The stock is nearing its 52-week high of $10.91, supported by a 50-day moving average of $10.06 and a 200-day moving average of $9.70. Hulic operates in diverse real estate sectors in Japan, including leasing, brokerage, and sales of properties such as office buildings, hotels, and senior housing. The rise in short interest could reflect investor skepticism about the company's future prospects or broader market conditions affecting the real estate sector. However, the recent uptick in stock price suggests some investor confidence, potentially driven by positive market sentiment or strategic developments within the company.